Thanks for listening to Investor Insights, a behind-the-scenes look at investing with Fund That Flip. This series provides an insider's look at how our business works and answers your frequently asked questions so that you can make better investment decisions with your hard-earned capital. Now, our founder and CEO, Matt Rodak.
Welcome to this episode of Fund That Flip's Investor Insights. I'm your host, Matt Rodak, founder and CEO here at Fund That Flip. And today joining me on the show is Scott Eilerman, our team lead for Underwriting and Valuations. Scott and his team are responsible for looking at every deal we underwrite and determining valuation, deal structure, and pricing. And today we're going to be talking about appraisals, how we use them, what we look for, and some of the reasons maybe our internal valuation may differ from what we get back on an appraisal. So with that, welcome to the show, Scott.
Great to be here. Thanks for having me on.
Yeah. So glad you're here. Maybe before we get kind of into the nitty gritty on appraisals, just give us a little bit of background on you and kind of what you do on a day-to-day basis here at Fund That Flip.
Yeah. So I joined Fund That Flip right after graduating from college here at John Carroll University outside of Cleveland, Ohio.
Go Streaks.
Go Streaks. I studied finance with a particular interest in real estate. So I ran into Matt over here and John at the career fair at school and haven't looked back since. On a day-to-day here at Fund That Flip, I mainly work with sales to qualify projects from borrowers that they've pre-qualified. I look at, the as-is values of their properties, what's their rehab plan or what we call their scope of work. We look at their previous work, their credit reports, and then we develop after repair values based on comps that we are seeing trade in the area. To date, I've probably had a hand in individually over 1,000 evaluations, about 1 to 2 a day for the past 2 years. So probably close to 1,000, but I've been hands-on with just about every other project that underwriting has looked at since I've joined the company. So the total number of valuations or loan requests that I've had exposure to is probably 3 to 4 times that number.
A lot of reps. Reps.
Yeah. So quick summary, my job is really just to help sales qualify projects so we can agree on terms and ultimately structure a loan so we get the borrower what they want in terms of leverage, but also being reasonable and making a safe loan for our investors.
Right. So you're getting involved and your team's getting involved kind of early on in the process. Sales brings you a project. We've got a borrower that we think we like. We've got a project that kind of pencils out. You guys are going to help them kind of do a little bit more than, kind of a sniff test. We're going to pull data from the MLS systems. We're going to, pull credit. We're going to do some of that qualification. And then, assuming we get a green light from sales and the borrower agrees to go forward with kind of the structured deal, then you guys are going to go a lot deeper on kind of that valuation, that full underwrite. Is that kind of safe to say?
Right. We pull comps from MLS data. We have access. Our automated valuation model, the software that we use, has access to, I think it's close to 400 MLS feeds throughout the country. So we use that to come up with our valuations as opposed to like Zillow or Trulia or Realtor or Redfin, any other of those listing sites. Typically, the MLS is more up to date than, for example, Zillow would be. Zillow is going to pull from public record most of the time. You can, as a realtor, post a sale on Zillow, but it's not always the case. So that's why we find the MLS data to be the best data. It's the most recent. It's the most up to date. It's real time, so it allows us to make educated decisions in terms of valuations.
That's a great point because I know a lot of our investors that are listening and are doing some of their own, underwriting from home. Will leverage Zillow or Redfin or some of these other systems that are out there. They are great systems and they have a lot of good data, and I think are particularly helpful around crime and kind of trends within the marketplace. But they may not have the latest and greatest data. So fortunately for us, our systems do plug right into those MLSs. We get not only kind of sold properties, but also things that are currently listed, things that are potentially going into contract, and a number of other data points that I think help us get to our own internal valuation. So you guys are doing a lot on the internal valuation side, and we'll I think have you back here at some point, or someone from your team back at some point, and you can run us through kind of our AVM and what we're looking for there, and what one of those reports maybe even looks like. But let's talk about appraisals, because appraisals are a big data point, I think, for us and for a lot of other lenders, and I think for people that are investing on our platform are going to be looking at the appraisal. So maybe let's just start from the beginning around, like, how do we order an appraisal? What are we asking for? Kind of how are we making sure that we're getting an independent third party?
Yeah, so we work with a number of third-party appraisal management companies, and they're basically have a network of these qualified appraisers around the country. So we make an appraisal request, and then they sign an independent appraiser to the job. They go out, inspect the property, pull their own comps, and kind of come up with their own individual independent opinion on the value of the property, and then kind of flag some things that us as a lender might be concerned about.
So I think this is an important point for folks that may not be familiar. The industry around appraisal management companies really popped up post 2008 as an effort to kind of separate loan originators having any influence over valuations in order for loans to get through underwriting. So similar to how the big banks and others use these appraisal management companies to provide a certain layer of independence between us as the originator and ultimately the person that's going out in the field and developing that valuation. I think it's just a good thing to call out, like, that exists and is a healthy thing for everyone, I think, to get to ultimately what we all want, which is an accurate, as we can anyways, view on what the property is worth. So there's different types of appraisals, right, that we can ask for, Scott. So maybe tell us a little bit of the different types of valuations, the valuation types or different type of appraisal requests that we may put in. What are they, and kind of what are we looking for, or why are we asking for those different types of valuations?
Definitely. So the vast majority of our loans will have a subject to value on them, so it's a subject to appraisal. Sometimes we do get what's called an as a.
Sorry to cut you off. Subject to, so that means like the after renovated value, right? Which is another term we use a lot on our platform. Right.
So ARV, subject to, they're the same thing. That's going to be, we'll get that on a vast majority of our loans, like I said. Also, we'll sometimes get an as-is value. And there's some situations where maybe we'll get an as-is opposed to a subject to, or both, or just a subject to. So when do we typically look for an as-is appraisal? When we recognize on the front end, when we're doing the initial underwrite, the initial valuation, or maybe it comes up a little later in the process, if we kind of believe and we have enough data points to tell us that that borrower may be overpaying for that property, that'll typically flag us to order an as-is appraisal.
Why would we care if the borrower's overpaying for the property?
If the borrower's overpaying for the property, they don't execute the rehab to the property and fund that flip ultimately has to own the property. We want to make sure our loan to value isn't 110%. We want to be around that 80 to 85% range.
Yep. So if we're another way to put it maybe is, right, if we're lending 80% of purchase, and let's just say simple math, they're paying 10% more than they should for the property, then really our loan to value is not 80% at purchase. It would be closer to 90%, which is something we want to obviously avoid, right? So we want to make sure that our loan to value is going against the right value. The right value may or may not be what they're actually paying for the property. Did I say that right?
Exactly.
Okay, cool.
Exactly.
All right, sorry, I cut you off. So 4 likely situations. One is we think the borrower is overpaying. What's the next one?
Right. So we don't see it too often, but there have been scenarios where a borrower, maybe they own a rental property and they've owned it for 10 years. Maybe they bought it in like 2006 and they bought it for $100,000 then, and now it's worth $200,000. We'll do our own internal as-is valuation, but we'll also get that second opinion from an independent appraiser to kind of tell us what it's worth today. Maybe the borrower plans on rehabbing it. And then so like that would be a situation where we get both an as-is and a subject to appraisal.
Got it.
And then the third one is construction is partially complete. Maybe a borrower's all cash into a property. Again, we want to make sure our loan to value at close is definitely no more than 90%, but we want to, like I said, keep it within that 80 to 85% range. Typically on loans like this, we'll probably be a little bit less than that just because it's a little more speculative with construction being partially complete. And then the last one where we get an as-is value is construction is either complete or there's no construction to be done on the property. So it could either be a borrower owns a rental property, all cash, they want to pull cash out of it to go acquire another property. That'd be a situation where we get an as-is appraisal. Another situation would be borrower finishes a flip, they're all cash into it. They want to pull money out of it right away to go acquire another property while it's sitting on the market. That's another situation where we would order an as-is appraisal.
Gotcha. So really, I think if I could summarize this, the reasons for why we would want to order an as-is appraisal is one, what we're trying to do is determine the accurate value of the property in its current condition, whether it's fully finished, whether it's under construction, or whether it's currently being purchased, but we're not 100% certain that the borrower is paying the right price for the property. And the reason that we want to do this is loan to value. We want to understand what our numerator is going to be in that fraction. And to do so, we got to know what the denominator is to make sure that we're not getting ahead of ourselves in terms of loan to value ratios.
Right. A lot of times the purchase price is a good indicator of the as-is value. It's a data point. Maybe it's not accurate of the current value of the property, but a lot of times it's close. So it's a starting point. So like in a lot of these situations, there really isn't a purchase price. So those are situations where we would want to get an as-is appraisal. Got it.
Okay. Cool. So we're sometimes looking to get a third party appraisal on the current condition of the property, the value of the property. Sometimes we're relying on our own internal valuation as well as what the borrower is paying for the property. But in almost all cases, we're going to be getting a subject to value appraisal or an ARV appraisal. Let's talk a little bit about kind of how those go down and what we're looking for in those.
Yeah. So like I said, most of the loans that we do are value add. So those are scenarios where we would get a subject to appraisal. And basically how that works is we get the scope of work from the borrower. We provide that to the appraiser. They review it. They see the property, its current condition. They compare that to the scope of work. Sometimes we provide them with the borrower's previous projects, get them as much data as we can so they can make an educated opinion of what that property is going to look like once construction's complete. And then the subject to valuation at the end of the day is just evaluation of the property in its future state. So post construction, what's the value of it? What would someone pay for it?
So this takes a little bit of vision, right, on the appraiser's part of, oftentimes you're going into a property that is, could be a little beat up, and we're saying, hey, there's going to be a new kitchen. There's going to be new bathrooms, new paints, new floors, new roofs, and asking that appraiser to kind of visualize what that end state's going to be and then find comps that are in line with that end state. What are kind of in our experience, what have been some of the challenges that we've seen with, getting what we believe to be, accurate subject to appraisals?
Yeah. Some appraisers are just good at it. They're more experienced with the as-is appraisal, kind of working with traditional banks with like mortgages, things like that. So we see some variance there just because, like I said, some appraisers, they're good at it. They're used to it. It's kind of maybe their niche or they're better at interpreting the scope of work. Mm-hmm. Other appraisers are just used to the as-is appraisals. So that's why we try to get them as many data points as we can. We try to get the most detailed scope of work from the borrower. We try to get pictures of their previous work so the appraisers can really envision what that property is going to look like post-construction.
Yeah, I think it's worth pointing out, right? I think about 6% of homes that are sold are flips. The other 94% are just like normal sales. So if you kind of make some assumptions that appraiser's workload is probably that percentage or similar to, right? Like, they're not doing a lot of these. They're not doing a lot of these kind of subject to appraisals. So, whereas I think, you mentioned earlier, you've done thousands of these, and your team does thousands of these. You just get more reps, and kind of it's a bit of an art, I think, that has to be learned. So that said, like, we get an appraisal back, right? I think whether it's a subject to or an as is, we're getting an appraisal back. It hits your desk. What are you guys looking for in the appraisal?
Yeah, so there's a lot of things that we look at in these appraisals. Some of them have to do directly, or they affect the valuation directly. Some of them they kind of do, but maybe you wouldn't think about it initially. So the first one is trends in the market. In the appraisal, towards the top, they mark some characteristics about the market, the neighborhood. Are property values stable? Are they increasing? Are they decreasing? What's the demand and supply like in that area currently? Is there a shortage? Is it imbalanced, or is it oversupplied right now? And then what's the market timing? Is it under 3 months, 3 to 6 months, or over 6 months? So we look at that to really get another data point on the actual market that our property's in. Obviously, if property values are declining, that would be a concern to us. If the market timing is 6+ months, that would be a concern to us. So getting those extra data points from someone who's more familiar with the market than maybe we are is something we definitely take into account. We look at the comps they pick. I think that's kind of the obvious one. How did they come up with their valuation, whether it's as is or subject to? So we'll take those comps, we'll compare them to our own internal comps. Maybe they use some comps that we didn't use. If that's the case, we'll add them into our analysis. We'll analyze those comps, and we'll say, hey, is this comparable that the appraiser used better than any of the comps that I use? And sometimes we'll switch some out to get the most accurate comp set that we can, the one that portrays the end value of our property or as is value of our property as best as we can. Some other things that we look at are is the property legally zoned? Is it legal non-conforming or grandfathered in, or is it illegally zoned, which would be a concern for us. We look at, is it in a flood zone? The appraiser pulls the flood maps, looks at that. Are there any adverse site conditions? Sometimes properties are next to a big industrial warehouse, or maybe they're on a busy street. We try to recognize and identify these as soon as we can when we're valuing the property. But sometimes, maybe Google Street View isn't available in that area, or it wasn't there at the time. The pictures on Google Street View are old. So it allows us to have more real-time data of someone who went to the property, who saw the property, things like that. If the appraiser notes anything physically or structurally wrong with the property, they'll note it. A lot of times they're making the assumption that the property will be renovated. So this is often marked no in the subject to case, because they're assuming all the issues will be remedied. Mm-hmm. But for the as-is appraisal, if there's a physical problem that maybe we don't know about, they'll mark it if it's obvious. We look at prior sales. Has the property traded anytime recently? That would be an indicator to us also. If, say, the property traded 2 weeks ago from the appraisal date for 20 grand less than our borrower is purchasing it, that's a red flag to us, because it tells us our borrower may be overpaying for the property, since there's two trades at such different values in such a short period of time. We also look at the sketch. The appraiser will sketch the property, take some measurements, and get us an accurate number on square footage of the property. And then the last thing we look at is the photos. The appraiser notes anything that they think will be a concern in terms of physical deficiencies or structural deficiencies. But we do our own due diligence on those photos and make sure there's nothing that's extremely concerning before we decide to put money out on the street on this property.
Yep. So a ton of really good data from someone that gets onto the property and then has a somewhat standard format for presenting that data back to us. So appraisals and appraisers are a great resource for us and for you that are listening as investors on the platform to kind of understand value of the property, either in its current condition or what we think it's going to be worth once it's rehabbed, which ultimately then informs the loan to value ratios based on, how we're putting money out on the street. So one of our investors recently wrote in with a question on this topic, specifically about appraisals, which is while we're actually doing this episode. So if you're listening, Jeff, thank you for the idea and other ideas. And others, if you're listening, and have ideas or topics that you'd like us to cover, please send them into investorrelations@fundthatflip.com. But one of the specific questions that Jeff asked was, how much faith should I be putting in an appraisal? And he's noticed that, sometimes our internal valuation number is a little bit different than the appraisal. And his kind of question is like, how much should I be trusting the appraisal? And like, which one is kind of the number for me to trust in terms of, how I'm going to be looking at my loan to value ratios? What do you say to that, Scott?
Yeah, it's a great question. The reality is that any subject to valuation, it's an educated estimate based on what the future value of that subject property is based on certain assumptions. We think of the appraisals as another data point, and rather than a solid data point, it should be used to inform an investment decision, but it's not a guarantee by any means. We do occasionally get appraisals that are just way off, whether it's on the high end or the low end, and that could be for any one of many reasons. Maybe their comps are extremely far away, whereas ours are closer to the subject property. Or they didn't make proper adjustments that kind of make sense based on what we've seen historically, or maybe just the dollar per square foot. Maybe the properties they're using are so much larger, and the dollar per square foot is either depressing the subject property's valuation or artificially increasing it. So those are some of the specific things we see, but we do see appraisals that either come back significantly lower than our internal valuation, or on the other hand as well, significantly higher.
Yeah, and it really is a good question that Jeff asked. And I think, when we've looked at hundreds, maybe thousands of appraisals at this point. And I think, our view is that, yeah, like you said, Scott, they're a great data point. They've got a lot of information, not just on the property, but on the market, photos, perspective on which comps to pick based on relative style of the home and what's popular in the markets. So there's a lot of good data, but we're still asking this person that's doing the valuation to predict what the thing is going to sell for once it's complete, subject to a lot of assumptions. So not an easy task. And I think the other thing that's worth knowing for you guys that are out there listening is we are doing a decent amount of quality control, and Scott's team is doing this, that if we get an appraisal back and it just seems way, way off, and there's a good reason that it's way, way off, we're not going to put that up there on the site for you guys, just because it's probably not helpful. But we are going to send it back with a list of reasons as to why we're rejecting the appraisal, and we're oftentimes going to be getting a new one to come back that we believe has a better comp set. So if there are differences in our number versus the appraised number, the reason may simply be is like, one, we want to present to you guys another perspective on valuation. So certainly consider it as an additional data point. But Scott and his team also do, I think, a pretty nice job in the valuation section of the website, on the investment page, providing their methodology as to how we came up with our value. So dollar per square foot, other comps that have sold kind of within different ranges of dollar per square foot. So you can also see, how we got to the number that we got to. So all of that being said, we do have enough data now that we've gone back and said, what did we think this thing was going to sell for from an ARV basis? And what did the appraiser think it was going to sell for based on their ARV basis? What have we learned, Scott, in terms of like our ability to predict the right number, the appraiser's ability to pick the right number, and generally speaking, like how close are we?
Yeah, so we've pulled some historical data with actual sale prices of the properties that our borrowers plan to sell. We're typically within 5 to 6% conservative on the final sale price, so 5 to 6% lower than the actual sale. And appraisers are typically 5 to 9%. conservative on the actual sale price. So the low end of that range is similar, both at 5%. We just there's less deviation in our after repair values versus the sale price, which kind of tells the story. We have some appraisers are really good at the subject to valuation. And then we get some who aren't used to it. They're used to the as is valuations. And that's probably why you're seeing a little bit more variation in the appraisers' variation from the sale price versus ours. We're doing this every day. We've had thousands of reps at it. It's what we're good at. It's what we do. And that's why you're seeing less variation in our number.
Yeah, so it's a tighter control group, right? We've got consistency with the same group of folks doing the same process over and over again. The appraisers, they're numerous, spread out in a variety of different jurisdictions, and probably doing on a volume basis less. So again, I think it's a good data point. It shows that we are doing, I think, a pretty good job collectively at getting the values pretty close to right, which is difficult to do, I guess, as we're kind of trying to guess what the property is going to sell for 6 to 9 months out. So, well, this was great, Scott. I really appreciate you swinging by and sharing some knowledge. I'm going to try to maybe bring it home for us. I think kind of the 3-4 points that I like to think about in terms of valuations are that, first, appraisals are a great data point, particularly because they're provided by a third-party independent kind of voice that's regulated and held to a certain standard. The fact that we're sourcing these through a third-party management firm adds in that additional layer of independence. So something I think that is important if you're listening to kind of understand where these appraisers are coming from and kind of who's ordering the appraisers. I think the other thing here is, like, some appraisers just naturally are going to be better at seeing future value than others. So there's going to be a little maybe less consistency in the appraised kind of values than maybe our internal valuations. But again, that being said, we are doing some quality control on these, and the ones that we post do have some merit and have been kind of, again, some rigorous review from making sure that the comps are right and kind of we think they're seeing kind of the end value right. I think maybe the last thing is, I know a lot of people are doing their own valuation using public sites like Zillow and Trulia, and that's great. You should be doing that, but I think just also realize the data that you're getting there does come from public record that may be 3, 4, 5, 6 months or more old. So just kind of realize that if you are seeing some discrepancies in our perspective on value and what you can find on the public records, double check with the appraiser, the appraisal, because you're likely to see some more updated data there. So I think that's it. Let's Scott, let's get him out of here on a fun note. What are you doing outside of work when you're not pouring through valuations here at Fund That Flip? What do you like to do for fun?
Yeah, so when I'm not at work, I'm a big sports guy. So whether it's going to a game, basketball, football, baseball, watching it on TV,
OBJ, baby, Brownies.
Even OBJ coming to the Browns.
Yeah.
Exciting time to be a Cleveland Brown. Other than that, like playing sports, I play basketball twice a week. So that's kind of what I like to do when I'm not here making the dream come true at FDF.
Awesome, man. Keeping fit. Well, appreciate you stopping by. For those of you listening, please send us your feedback. This whole series is still relatively new for us, and we're looking for what you like, what you think we can do better, any ideas that you have for content you'd like us to cover. As I mentioned, someone sent in an idea for this episode, so super appreciative of that. But email it over to investorrelations@fundthatflip.com, and we'll get it into the mix. Otherwise, be sure to check out our blog for other great content, including more of these episodes as well as written content. Otherwise, look forward to having you guys listening next week, and really appreciate the time. And until next time, this is Matt signing off.